What's going on, guys? Welcome back to the channel. It's your option trading coach friend here, Henry. And as always, guys, I'm not a financial advisor, but I used to work in financial advising and I have a finance degree, had a job at Goldman Sachs. And I'm just here to teach you everything that I know about option trading. And at the end of the day, I'm here to help you make some more money. I hope you're having a great week. Today's video is going to be about buying call options. Call options can make a lot of money and they're very important to have in your option trading toolkit. Whether you're a beginner or you're an advanced trader, this video is going to cover everything that you need to know, walk you through some examples, the Greeks, the behavior of options, and basically get you to the point where you can make some money with call options. Now, I have to admit, I don't buy as many call options as I sell options because I've had more experience and better results selling call options. However, I bought Lulu call options last quarter and turned $970 into $3,720 for a 280% gain. I actually documented that and I have a video for it in the description, but all you have to know is it's possible to 2x or 3x your money or even more using call options, especially if you pick call options at a great value. For example, if you pick a call option right before earnings and the stock reports some good earnings and ends up riding higher, you will make a lot of money. The same also goes for buying call options on stocks that have a good catalyst. A great catalyst can also make the value of the stock rise, therefore the option will rise many times the value of the stock itself. I'm going to show you an exact example right here on one of these stocks on my screen. I'll probably pick a more volatile stock to show you the potential money that you can make. Now, I do want to say I am planning on buying a lot more call options and mixing this into my option trading. I will be using a lot more call options in my portfolio, especially in 2022. So if you want to follow along, I have a private Discord. It's going to be the first link in the description. Joining is for the benefit of the community, but all I really ask of you guys watching is that you like this video because it helps out the YouTube algorithm. It helps YouTube know that you're having a good experience, push my video to more people, and allows my teaching to reach more people. So thank you so much if you do drop a like on this video. Now, the first thing that you really need to do if you're going to be buying a call option is that you need to pick a stock that you think can rise. That's the real assumption here, okay? You need a stock to go up because a call option is essentially giving you the right to buy 100 shares, but not the obligation to buy 100 shares. This is a bullish strategy, and in fact, you can take profit on the call option anytime you wish. You don't actually have to hold it up until expiration. For this example, I'm going to scroll down and pick Tesla stock. The reason I'm picking Tesla stock is because it has a lot of momentum. This stock has been riding higher for a long time. I own a lot of shares here, but obviously you pick a stock that you're bullish on. This is just an example. So what you're going to want to do on Robinhood is go to the bottom right of your screen, and if you're using the mobile device, it's going to be the same option button on the bottom. Now click Trade Tesla Options, okay? Now the settings will give you the first expiration date. Expiration date is really important for us to discuss because the hardest thing to really pick is expiration date and strike price, but I'm going to simplify that. For expiration date, you just want to pick an expiration date that's going to capture either earnings or a catalyst. A catalyst is much more difficult to estimate because sometimes stocks have catalysts that you weren't expecting. However, a Fed meeting could be a very good catalyst for a bank stock, or vehicle deliveries could be a very good catalyst for a company like Tesla or any of the auto manufacturers. Now, another way to pick an expiration date is just to go out a significant time period, say 3, 6 months, or even 1 year if you have a longer term view on a stock. For Tesla, I'm just gonna go scroll down and pick something around May 20th. That gives me about a 5-month period, or actually 6-month period to work with. That's half a year. I'm very comfortable with that because it's not a very long period, but it's also not a short period. So Tesla will at least have 1 earnings event during this period and potentially even 2. The thing is, that's even less important because at first when you buy a call option that has an expiration date that's 6 months out, is going to have very low theta. Theta is the time decay of an option. And because there's so much time, at first you're not really going to see the option erode too much. So it's beneficial to buy an option that has a lot of time to it. Now I clicked May 20, 2022 Tesla call option. I'm going to give you a full walkthrough of what I would look at and how I think about buying this call option. If you're really bullish on a stock, then it makes sense to pick a strike price that is out of the money. For example, if you believe that Tesla can reach $1,400 per share, then you're going to want to pick a call option that is less than $1,400 per share. However, if you just think the stock will go up, but you're not sure how high it will go up, it's best to pick an option that is near the money, because if the stock rises, I'm going to show you how much this option will rise. For example, if we pick the 1050 call option, this is an at the money call option. It's the nearest to the money strike price that we have on Tesla currently as I'm making this video. So expanding the 1050 call option right here, there's a few things that are really important for us to discuss. I want to give you guys a walkthrough of the Greeks. As you will notice right here, we have delta, gamma, theta, vega, and rho. All of these are representative of one share. Remember, each call option is worth 100 shares, so we need to multiply these numbers by 100 to get the true Greeks. So delta has two different definitions, okay? They're both really easy. One of them is for each dollar move, delta tells you how much the option will move. So for example, if Tesla stock goes up by $1, this option will rise by 58 cents and the premium will increase by 58 cents. Now, if Tesla goes up $10, then this option will rise by $5.80. The second definition of delta is how likely this option will expire in the money. So currently there's a 58% chance that Tesla will expire at $1,050 by May 20th, 2022. So delta gives you most of the information, and to be honest with you guys, I really just look at delta and theta. However, gamma is also important. So let's say that there's a $1 rise in the stock. The delta will rise by 58. However, the gamma gets added to the delta. In this case, gamma is really low. So even if Tesla goes up $100, the delta would only change by about 0.08. So the new delta would be about 66. That's because Tesla is a very volatile stock. We can see that by looking at the implied volatility. The higher implied volatility, the more stock moves. So Tesla currently has 67.5 implied volatility. And because there's so much time, May 20th is 6 months away, that means that gamma is really low, because even if things happen in the short term, that doesn't really make that much of a difference, because so much more can happen given we have a 6-month time frame for Tesla stock to move up and down. That's why gamma is currently so low. However, as the option approaches expiration, gamma will increase. If the stock moves up by $1, you add the gamma to delta. If the stock moves down by $1, you actually can subtract the gamma from the delta. So aside from delta, I really do like looking at theta. Theta is the time decay of an option. Every single day, you can count yourself losing about $56 if you're buying a call option. So that is one of the drawdowns of buying call options, is you are paying money up front to see some type of event occur and to ride the stock in one direction. However, again, this is not a bad strategy, especially if you're bullish on the stock and it ends up rising. At first, theta is actually not that much, because right now you're going to be paying about $56 per day to rent out 100 shares of Tesla. Now, if you were to buy 100 shares of Tesla, it would cost $104,500. So instead of buying 100 shares of Tesla, you can actually still control 100 shares of Tesla without having to pay that big upfront price. In fact, all you have to pay upfront is going to be the premium of the call option. So it's going to be $18,000. Now, that's still a large amount. That's why you don't have to use Tesla. You can buy call options on stocks that are way cheaper than Tesla. For example, if you do this on something like American Airlines, maybe your premium that you pay might only be like $90 or $180. It'll be a tiny fraction. I'm just showing you Tesla stock because it's an expensive stock, and buying call options might be the best way to have exposure into the stock without having to need all of the collateral to buy the shares. So buying a call option in this example cost 1/5 of the price of buying 100 shares of stock. But I actually have another example for you guys that may be better, especially for smaller portfolios. All right, so I'm going to show you a second example. Now, this example is going to be really interesting because it's going to require less money, give you more time, and less risk up front and more potential reward. So this is going to involve me changing the expiration date. Rather than going for May 20, I'm going to scroll further down and go for a longer expiration date option. Now I'm looking at January 20, 2023, which is basically over a year from today's expiration. It's about 13 months away. So I'm going to click January 20, 2023. Now, again, I'm going to buy a call option. However, you guys will notice right here that instead of $18,000, it's currently trading for about $28,000. So it's an extra $10,000. However, in this example, you do not need to buy an at the money option, because if you're bullish on a stock, whether it's Tesla or whatever stock that you pick, and you have over 1 year on the option, it's actually called a leap option. It's a long-term option. Now, this option captures 4 quarters. Those 4 quarters are going to have more earnings events than 6 months, and a lot more can happen during this extended time period. So you don't have to go for an at the money option. In fact, I'm going to scroll up and pick an option that is way cheaper. So as you will notice right here, the higher you go in terms of strike price, the cheaper the premium gets. That farther out of the money options have lower delta, therefore a lower chance to actually hit the strike price. Therefore, the market applies a smaller premium. So here you will see the 1400 strike price price is worth $17,880. So it's slightly less than the call option that we were looking at before, but there's a huge benefit here. The risk is slightly less because you're paying less money up front. However, the expiration date is so far into the future, it gives you a lot more time to play the stock's momentum. If I expand this option, the delta is lower, it's 0.46. However, the theta is also a lot lower. So buying this call option actually costs you less money up front, but also per day to rent out 100 shares of Tesla, it's also cheaper. Now the delta is slightly lower, but remember guys, you can close this option position at any time that you wish. You do not have to wait until expiration. So for example, let's say that you bought this call option. Now in 1 month from today, let's say that Tesla stock goes from $1,042 to $1,142. So Tesla stock will go up by $100. That means given that our delta is 0.46, if we multiply the delta by $100, this option will rise by 46. So we will round up to $50. So the new premium is actually going to be about $50 more, or in this example, the new option will be $22,000. So you can turn $17,000 into $22,000, which is basically right around 30% return in one single month. Now, of course, theta will eat into that premium just a little bit, but 30 days times about $35 per day is going to be about $1,000. So your actual profit won't be $5,000, it will be $1,000 less. But again, notice how you can make $4,000 on a $17,000 investment, which is now closer to 25% return. So again, you're owning this option that's expiring January 20th, 2023, but nothing is going to stop you from taking profits 1 month into owning the option and making, for example, a $4,000 profit. Also, keep in mind, Tesla stock can actually move sideways, but if the market becomes more volatile, implied volatility increases, your call option will actually be worth more money. So buying call options has many benefits, but one of the biggest benefits is that you get to control 100 shares of stock without having to pay up 100 shares worth of capital. If you guys have any comments, make sure to drop them down below. And also check out the private Discord. I do make live buy and sell decisions there, so you can watch everything that I'm doing live. And if you want another video on call options, I'm gonna put it up on the screen right here, and also drop the best call option video on YouTube in the description. Thank you so much for watching. I'll see you in the next one.